Welcome to the Explainer. So, if you're a new investor taking those first big steps toward long-term growth, you are in exactly the right place. Today, I am incredibly excited to help you demystify one of the most talked about funds in the entire world, Vanguard's S&P 500 ETF. Now, ETF just stands for Exchange Traded Fund, basically a big basket of stocks you can buy all at once. And this specific one is widely known by its ticker symbol, VOO. We're going to break down exactly how this fund works, why it has completely captured the attention of the financial world, and how it might just fit into your own strategy for building lasting wealth. Let's start with a massive milestone that made headlines in June 2026. Just think about all those zeros for a second. VOO crossed $1 trillion in assets under management. It actually became the very first ETF in history to do so. That is a staggering amount of money, and it really speaks volumes about where everyday investors and massive institutions alike are choosing to park their cash. All right, here is our roadmap for today. We'll hit the trillion-dollar milestone, decode the actual VOO strategy, dive into the incredible power of low fees, uncover a hidden concentration risk you absolutely need to know about, and finally, map out your long-term game plan. Starting with Section 1, the trillion-dollar milestone, and the truly historic inflow that got us there. You know, that breathtaking $1 trillion number didn't just happen overnight. The sheer momentum here is what's so fascinating. VOO added roughly $250 billion in assets during 2025 alone, and to push it over the edge into that trillion-dollar territory, it saw a reported single-day inflow of $1.7 billion in June 2026. Because of this relentless, snowballing pace, VOO actually overtook its oldest rival, SPY, in early 2025 to become the largest ETF in the world. And honestly, it's just kept widening that gap ever since. Moving right into Section 2, decoding the VOO strategy, or as I like to call it, simply buying the haystack. So what is this massive financial vehicle actually doing with all that cash? Well, to understand VOO, you have to understand passive investing. As Vanguard explains it so brilliantly, instead of trying to find the needle in the haystack by picking individual winning stocks, which, let's face it, is incredibly difficult to do consistently, passive funds like VOO simply hold all the securities in a specific index. In this case, VOO buys and holds all 500 of the large-cap U.S. companies that make up the S&P 500 index. You aren't stressing out trying to guess who will win. You're literally just buying the whole haystack. For a new investor looking to build long-term wealth, this approach comes with some massive perks. Vanguard's research highlights 4 key benefits. You get incredibly lower costs, diversification that helps reduce the volatility of any single company failing, really high tax efficiency, and relative return predictability. It's not about trying to outsmart or beat the market. It's simply about matching the market's performance with extreme, almost ruthless efficiency. All right, Section 3, the power of low fees and how they let you keep more of your hard-earned money. Because VOO is just mirroring the market, it unlocks an absolute superpower for long-term investors, and that is its unbelievably low cost. The only major differentiator between these giant S&P 500 ETFs is what they charge you to manage your money. This is known as the expense ratio. Just think about the difference here. VOO, along with its peer IVV, charges a tiny 0.03%. Meanwhile, the famous competitor, SPY, charges 0.0945%. So for everyday retail investors, VOO gives you the exact same 500 companies for less than a third of the cost of SPY. Now, you might be wondering, come on, we're talking about fractions of a percent here. Does it really matter? Oh, yes, it does. EBC Financial Group points out that a difference of just 6 basis points, which is literally just 6 cents for every $100 you invest, compounds into a massive figure on a large balance over time. A fraction of a percent might seem like a total rounding error today, but over a 20 or 30-year investing horizon, that fee drag is going to cost you serious wealth. Keeping your fees low is basically rule number 1. Which brings us to Section 4, the hidden concentration risk. Think of this as the AI plot twist. Before you go thinking VOO is just perfectly balanced magic, we need to peel the onion a bit. The index has changed, and you need to know what you're actually buying today. The S&P 500 is what's called a market cap weighted index. That basically means the bigger a company is, the more of your money goes into it. And because a few companies have grown so astronomically huge recently, a stunning 40% of your money in this fund goes to just the top 10 mega cap companies. The other 490 companies are left sharing the remaining 60%. So the absolutely crucial point here is that when you buy VOO right now, you aren't getting a perfectly even slice of the American economy. Actually, scratch that. You are essentially taking a heavily concentrated position in a handful of AI-adjacent tech giants. Names like NVIDIA, Apple, Microsoft, Amazon, Meta, and Alphabet completely dominate the top of this list. And this brings us to a really vital warning. As EBC Financial Group put it, diversification by stock count is not the same as diversification by exposure. If the AI boom keeps roaring, VOO captures that incredible upside. But if AI monetization cools off, VOO captures that downside too. Because 40% of the fund is tied up in those top tech giants, you simply aren't as insulated as the label 500 stocks might lead you to believe. Okay, final stretch, section 5, your long-term game plan and how VOO stacks up against the total market. Now that you know the hidden mechanics of the S&P 500, let's look at your options. Some investors out there want even broader exposure, so they prefer a fund called VTI, the Vanguard Total Stock Market ETF. While VOO holds the 500 largest U.S. companies, VTI holds roughly 3,500 stocks. It grabs the entire U.S. stock market, including thousands of mid-sized and small-cap companies. And the best part? It does this for the exact same rock-bottom 0.03% fee. Choosing between them is actually a lot simpler than it seems. Why? Because ultimately, VOO is already inside of VTI. As Optimized Portfolio points out, there is no stock in VOO that you won't also find in VTI. Because VTI is also market cap weighted, over 80% of it is just VOO anyway. So choosing VTI simply gives you VOO plus a little extra volatility and the potential growth from those thousands of smaller companies. But hey, if you prefer to just stick with the massive, proven blue-chip companies, VOO remains an incredibly cheap, highly tax-efficient powerhouse. Get this, it has distributed zero capital gains since its inception in 2010. In plain English, that means way fewer surprise tax bills for you if you hold it in a regular brokerage account. It has truly earned its spot as the default destination for passive U.S. equity money. So I'll leave you with this to ponder. As you build your financial future, does the sheer dominance of those top tech giants excite you? Or does it make you want to cast a wider net and diversify further into the total market? There's really no single right answer here, but understanding exactly what is under the hood of the fund you're buying, that is the ultimate key to investing with total confidence. Thanks so much for joining me on this explainer, and happy investing.